CPSE Bond Plus STL Index Fund. Ever wondered what that's all about? Confused about it? Hi folks, this is Mrin Agarwal, and in this video I'm going to be decoding these funds, which are actually known as target maturity funds. So how do these funds work? Well, the fund basically buys bonds of this particular index, and this index basically comprises of government bonds, maybe corporate bonds, and the state government bonds. So the fund buys these bonds as per this particular index, so it mimics that index. And why does it do it, and what are the advantages? Well, in bonds there are two major risks. One is the interest rate risk and the credit risk. Now, since this fund is basically investing into state government bond, high quality corporate bonds, and the central government bonds, the interest risk in these products is very low. And since the fund is investing in government bonds, which could be central government bonds or the state government bonds, and very high corporate bonds, the credit risk in this product is very low. And as far as the interest rate risk, so what is interest rate risk? When interest rates move up, bond prices move down, and vice versa. And remember, we are in a rising interest rate scenario. So in this case, what happens to the interest rate risk? Because the bonds are bought and held to maturity, for those investors who hold this particular fund up to maturity, there is no interest rate risk, because they are basically going to get back the principal plus the accrued interest at the time of maturity. So you have fair visibility on the sort of returns you're going to get. It's a very safe portfolio in terms of the credit quality. There is liquidity available. Since this is an index fund, you can buy and sell it anytime with the fund house. It is also available in the ETF form, which means that you can buy and sell it on the exchange. So unlike FMPs, there is no lock-in and there are no liquidity issues in this particular product. The index is also constructed in such a way that each bond or each bond issuance does not have more than 15% allocation. So it is fairly diversified. And we had seen issues in FMPs earlier where FMPs got very concentrated towards particular bonds. So you don't see those issues over here as well. So all in all, the product does satisfy all the qualities of a good product, which is safe in terms of credit, no interest rate risk, well diversified, low cost, and having a lot of liquidity. So should you invest? As with all other debt funds, the taxation on this particular product would be, if you exit before 3 years, it is fully taxable at your tax slab. And if you exit after 3 years, it qualifies for long-term capital gains, which is taxed at 20% plus indexation. Now, my take on this product, I think this is a good product for people looking at locking in for a fixed period. Let's say that you have an option of investing in a 3-year FD and you have this particular option of a target maturity fund. I would think that the target maturity fund would give you a much better post-tax return. So all in all, it is meant for people who want a specified investment period. They want to lock it in for a period. They don't want a regular return out of the product, because remember, you're going to get the money back only at maturity. But keep in mind that with the rising interest rates, you might get better interest rates couple of months down the line. So don't lock in too much. And again, I would like to reiterate that target maturity funds are really meant for people who want predictability of returns. They're willing to lock in their money for a couple of years and want to invest in it as an alternative to the fixed deposit. Make sure you click on the bell icon to subscribe. We do look forward to your feedback. Till then, bye-bye.